I think we're still waiting for a few people to arrive, but I want to welcome everybody. My name is Ruth Wilcock, and I'm the Executive Director of the Ontario Brain Injury Association. And I want to welcome everyone and thank you so much for joining us today for an open discussion about the Disability Tax Credit and Registered Disability Savings Plan. And I know today that we have people from all parts of the province, but I want to start off right by paying respect to the original peoples of the territory upon which the Ontario Brain Injury Association, or OBIA, is physically located. So the land on which we gather today is the traditional territory of the Haudenosaunee and Anishinaabe peoples, many of whom continue to live and work here today. This territory is covered by the Upper Canada Treaties and is within the land protected by the Dish with One Spoon Wampum Agreement. Today, this gathering place is home to many First Nations, Métis, and Inuit peoples, and acknowledging reminds us that we owe so much of our standard of living to the resources and friendships of Indigenous peoples in our community and indeed across all nations. For those of you joining today that are new to Zoom, now 2 years ago, probably most people were new to Zoom, and now there might just be a few that are new to Zoom. But just to let you know, we'll be using the question and answer feature at the bottom of your screen to ask the presenter any questions. Also, if you think of a question during the presentation, please select that button and type your question in. If you see that your question has already been asked, you can select upvote to move it further on the list. And now it truly is my pleasure to introduce to you Daniel Carroll and Maria Campanella from Hudson Wealth and Trust Planning Group to begin our discussion today. Daniel Carroll and Maria are both senior partners at Hudson Wealth and Trust Planning Group, which is a financial planning firm that specializes in working with survivors of personal injury, including acquired brain injury. They, along with their third partner, Percy Pierre, founded Hudson Wealth after searching for a similar solution and finding that none really existed. Since then, they have grown the company to become the premier financial planning firm in Ontario for people with disabilities and have established the core curriculum for other financial professionals to achieve certification as a disability finance specialist. And so I just have to say just how very grateful I am to you, Daniel and Maria, for taking your time and coming on and sharing this information. And I want to share with everybody that Maria and Daniel have donated their time completely to share with you about this really important topic. So again, thank you so much, Daniel, Maria, and I'll hand it over to you now.
Thank you, Ruth. Thank you for that warm welcome, and we're happy to be here. Maria and I, as Ruth said, have spent a long time growing our practices in the area of disability finance, and out of a necessity, largely because when we were seeking out other sources of information of other financial professionals who might be able to help with clients who had acquired brain injury or spinal cord injury or who'd suffered a loss in some way, shape, or form, we were unable to do it. So after a few months of practice, we really dug into research and went back to the drawing board and built this. And over time have developed a number of services really focused to help people who suffer from injury and disability and loss. The company has grown, as Ruth said, so I won't go in and repeat all of that. But we do provide these services in a number of different ways to people with disability. And if anybody wants to know more about that, we can discuss. That's not a purpose of today's meeting. It's not about marketing, so I won't go all the way down that rabbit hole. But Maria, if there's anything I've forgotten, then do jump in and fill in the blanks, please.
Well, we're happy to be here. Thank you for the opportunity, Ruth, to let us share this information. We know that this information is not widely understood in this area, and we're happy that we can shed some light on it and give back those little pieces of information that could really mean the difference in people's lives. So thank you.
So I'm going to share my screen here as we move into the presentation. And pardon me if I struggle a little with the IT. I'm not the best at it. But the purpose of today's session is to cover, excuse me, in a high value way or high level way, what the nuts and bolts of the disability tax credit and the RDSP are. These are fairly complicated instruments. However, some of the initial steps and some of the initial concepts are fairly simple to understand. So we're hopefully we're going to get through those. We are going to move at a very quick pace today, which I know is not something we would normally do when presenting or working with someone with an acquired brain injury. However, we want to get through some of the basic information first so that we can get to the questions quickly, because there's some really great questions that came in, and I think there's far more value in addressing those and answering those, and of course any questions that come up in the Q&A session today. We will be sending a summary of this presentation out, as well as all of the links that come up in this, the links to different government sites and pages and more information, so you don't have to scramble to write that down. Maria will be putting them into the chat so you can copy them from there, or OBIA will send them out to you after the presentation. So without further ado, let's jump into it. And very quickly, right from the government's website, what is the disability tax credit? Well, it's a non-refundable credit that helps persons with disability or their supporting family members or persons reduce the amount of income that they may have, income tax that they may have to pay. The purpose of the DTC is to provide greater tax equity, and the CRA and the Disability Advisory Committee and where all of this came from, without going too far down the rabbit hole of history, was basically to recognize that people with disabilities have higher costs. They have greater costs in medical care, in therapy, in treatment, in traveling and moving about the day-to-day life. So the concept here was to provide some equity by balancing the scales a little bit by allowing greater write-offs. Now, there are some basic write-offs that most Canadians are entitled to in the way of medical things. But in addition to that, the disability tax credit allows for more, and we will get into that. For the purpose of today's presentation, we are using 2021 numbers. The 2022 numbers just came out, but they're very similar. So essentially what this does is it provides about $8,000 or about $8,800 now for the current year, but a little bit shy of $9,000 for adults, $5,000 for minors in those additional tax deductions. And it is the gateway to the RDSP. You cannot open an RDSP unless you've been disability tax credit approved. And we recognize that survivors of ABI or TBI have what's called the invisible disability in many cases. So what we want to try to illustrate today is how people with acquired brain injury can sort of instruct the medical professionals in their lives to help them qualify and speak the right language so that they improve their chances of being approved for the disability tax credit. So with that, what does the application process look like? Well, there's an application form, obviously, and the first bit of the form, the first part, is about the person with the disability and the person who's going to be claiming the credit. Those do not have to be the same person. Obviously, if you're not working, the disability tax credit doesn't do you a lot of good because you don't have a lot of tax exposure. Save and except, of course, if you have investments or revenue property, or there's other streams of taxable income, in which case then the disability tax credit would be valuable in your hands. But in a lot of cases, the one who claims the credit is often a loved one, a family member, a care provider, or something along those lines. So we have to consider these expenses that the insurance company or OHIP do not cover. Who's paying for those? Who has the highest tax bracket? If mom and dad are looking after you, maybe the tax credit's better in dad's hands. Maybe it's better in mom's hands. Maybe it's better in the sister's hands. Who knows? So all of that kind of depends on who's at the highest bracket, because that's where you stand to get the most savings out of this. And you can adjust previous returns. They can go back in time, I think, as far as 10 years for adjustments. And this can be done either by CRA directly, and there's just a box on the form that you check if you want to have previous returns adjusted, or you can have an accountant go back and forensically adjust the returns and resubmit on your behalf. Obviously not something you really want to get into yourself, typically best in the hands of CRA or a professional in the world of tax. The second part of the application is for a treating medical practitioner. And that can be a family doctor or a GP, a general practitioner, a nurse practitioner, occupational therapist, psychologist, etc. In the case of acquired brain injury, we find that the highest success rate is in neuropsychology, psychology, psychiatry, somebody who is able to speak to the impairments of the mind and the mental state. These are the reason for this is, again, because I said, as many of you know, that an acquired brain injury is often deemed to be an invisible injury. So you want the right doctor to speak to this. So when it comes to an occupational therapist, they can only speak to feeding, dressing, and these sorts of things. So we really want to get into more of the medical diagnosis from preferably a doctor with a medical background, and failing that into psychology or somewhere in that area. These areas of impairment can be a collection of all of them and how those add up to what's called a whole person impairment, or a marked impairment. In one area, the person is substantially impaired. So that's kind of what the medical practitioner has to convey to CRA. And the areas are vision, speaking, hearing, walking, eliminating. I can read the list, but you can read them too. I'm sure many of you already have. And these are the sorts of things that have to be addressed in that portion of the form. Now, some of the potential pitfalls in this area is that the medical practitioner does not use the right language. It has to be digestible. You have to remember that it is not a medical person on the other end of this that's reading this. It used to be, but not anymore. And there also have been a few other changes in recent history that have come about as a result of an advocacy group called the Disability Advocacy Committee, Advisory Committee, excuse me, and they have done some good work to have somebody with a bit more of an appropriate background review the application, but it's still not perfect. So having that language be conveyed clearly by a medical person is the only way to get this done properly. And they need to speak not in terms of diagnosis, but in terms of effect. So need to be specific as to which impairments they're addressing, and speak to the duration and explain what the effect on the person's day-to-day life are, what those effects are. So the process can take anywhere from 1 to 6 months. It can now be submitted online, and we are seeing a faster turnaround time as a result by those who submit online. If you are submitting by paper, you want to make sure that you keep a copy of it, because we can't rely on Canada Post as often as we'd like to. Things do get lost. They get lost in the shuffle. You want to make sure that you're not going back to that medical professional to fill it out again, and that you have a copy that can be resent if by chance it doesn't make it to the right destination. Per the right destination, you want to make sure that you're sending it to your tax center. So not to the CRA office in Ottawa. Summerside PEI is a tax center. Sudbury, Ontario is a tax center. Depending on what your postal code is, you have an assigned tax center where your tax filings should be sent if you're doing that by mail. And make sure that it goes to the right one, or it'll either get sent back or get lost in the shuffle. And CRA may request further information from the medical practitioner, and all of this creates lag time, which, again, in the interest of time, because time is money, we don't want to have additional lag if we can avoid it. Once approved, you could be approved for 1 year, 5 year, 10 years, or indefinitely. And if you're approved for anything other than indefinitely, you will have to renew as you approach that anniversary. And typically they do send out a letter saying you're coming up for renewal, please resubmit. But again, don't rely on that happening automatically. You want to make sure that you're noting when it is so that you can yourself prepare for resubmission when that renewal period comes up. So what can be claimed for a deduction? Here's a list, and of course the corresponding line numbers for the T1 general filing. But there are 140 items, medical items, that can be submitted as expenses. And the last link on this page speaks to them. Again, we will send out the links, so don't feel like you need to write them all down. In fact, that one doesn't even show the URL. So we'll go through them. You'll get a copy of them for people who want to go in and see the specifics. But these are the key features that you want to be putting on your T1 general filing. There's also help from the province of Ontario. So when we talk about disability tax credit, we're talking about CPP, CPPD, it's all CRA, it's all federal, it's all run by the federal government. Same thing when we're talking about the Registered Disability Savings Plan, grants and bonds and things like this. These are all federal programs, but the provinces also have support programs. And some of you will be familiar with the Ontario Disability Support Program, but there's also the Ontario Community Support Program for low-income senior or person with disability in need, such as those in need for supportive housing or community-based independent living programs, these sorts of things. You can get paid subsidized delivery of meals, delivery of medicine, other necessities, and that can be found through that link that's on the screen. So with that, I'm going to hand things over to Maria. Maria has an incredible working knowledge of the Registered Disability Savings Plan. She's been working deeply with these for quite some time. So I will pass the conch over to her to speak to them.
Thank you for the introduction, Daniel. So let's get into the RDSP. What is it? Well, the government realized back in 2007, 2008, that people who have suffered an injury or are disabled may no longer be able to earn an income and therefore accrue RRSP contribution room. Now, the reason for RRSP contribution room is to defer taxes on retirement savings. So they've created the Registered Disability Savings Plan to mimic that in a way. There are subtle differences. However, this is a plan for long-term savings. Grants and bonds are there to help offset some of the increased costs of those disabilities or injuries in those sunset years. Now, we want to get that started as soon as possible because those grants and those bonds start to earn income and growth. Okay, we can reach back for some of those grants and those bonds, but the missed growth on that can be significant. Now, when to start contributing? Well, we'll get into some of those details, but the requirement that the government looks at is family income, and that family income will change when the beneficiary turns 18. So there's a little bit of a strategy to go on there. It is a good place to pursue higher rates of returns because of that long time horizon. So time horizon is one of the larger factors in determining risk tolerance and capacity for clients. If you have a longer time horizon, which you will see the government tries to force that 10-year timeline, you may be able to go after some growth in this account. Now, it should be incorporated into your overall financial plan. We'll touch on some of those plannings at the end of the presentation, but there could be RSP rollovers, some estate planning that can go into this account to really shelter some of that tax and leave more for the beneficiary at the end of the day. Now, in a nutshell, there's a lifetime contribution limit of $200,000, meaning someone can only contribute into the RDSP $200,000. Now there's $90,000 of government contributions up for grabs, $70,000 in grants and $20,000 in bonds. In order to trigger those grants, we need to contribute a portion of that $200,000 every year. So we'll get into an example. The magic number is usually, in most cases, about $1,500 a year. So we want to make sure that we're not putting in $200,000 this year, because next year we won't be able to put in the $1,500 needed to trigger more grants and bonds. Okay. Now, the RDSP, it also may help protect some beneficiaries from losing government benefits. It is considered an exempt asset. So again, that comes into that greater planning on how to preserve ODSP, how to preserve other government benefits for the long term looking into the future. Now, to set up the RDSP, Daniel mentioned you need the disability tax credit to be approved. The beneficiary must have a valid SIN number, and the holder must also have a valid SIN number or a business number. The holder may be different than the beneficiary. It may be a mother or a father as the holder or a grandparent, and junior as the beneficiary. The beneficiary must be a resident in Canada, and the beneficiary must be 59 years of age or less in the year that you open this. So if you're turning 60 this year, you're no longer eligible to open an RDSP. Okay. Contribution details, well, unlike an RRSP, when you put money into the RDSP, which is what we're talking about, it's not tax deductible. However, once you put it in, it will grow tax deferred. Okay. We talked about the limit. Okay, so you can no longer make contributions after that limit is reached. You can no longer make contributions after you turn the year in which you turn 59, or when the beneficiary has passed. There's a 10-year timeline, so early withdrawals may be subject to some clawbacks. I'm going to get into more details in a few slides, but it's something to remember. There is a 10-year timeline, which is one of the reasons we want to collect all those grants and those bonds as early as possible. 1 for clawbacks, 2 for the growth that could occur on those contributions and grants and bonds. Now, the grants and the bonds can only be triggered when the beneficiary is 49 years of age or younger. Okay, so if you're 50 to 59, you can open an RDSP, you can contribute, but it will not trigger grants or bonds. If you're 49 or less, contributions will trigger the grants. Okay. So next slide. The grants. Let's get into some details. So when family income is below about 100,000, the government will match 3 to 1 on the first 500 and 2 to 1 on the next 1,000. That means that for 1,500 of your contribution, the government will put 3,500 into the account. For family income over 100,000, they will match 1 to 1. Okay. Now, beneficiaries can carry forward up to 10 years of unused grants and bonds. However, only 2 years at a time. Now, up to 10,500 can be paid in each year. So that's the current year plus 2 previous years. There's an underlying calculation the government will do to give you the maximum grants, but ultimately 4,500 should trigger current year plus 2 previous years, yielding 10,500 in grants. Now, bonds is a little different. Bonds, you don't actually have to contribute in order to be granted, in order to collect the bonds. We're just on the next page here, so I'll wait for those numbers to give you a visual of what I'm explaining. Now, if you're eligible without contributions, the government could put in $1,000 per year if your family income is below about 32,000. Family income, again, family income is based on the beneficiary's family if they were under 18 years old, or their own income if they are 18 years old or older. If income is between 32 and 50,000, they prorate it. Okay, so you could get anywhere between $1 and $1,000. And if family income is over 50,000, you won't be eligible for the bonds. However, you will still be eligible for grants. Because the RDSP was created in 2008, you can reach back up to $11,000 per year in bond money. Okay. So again, a reason to get it open as soon as possible. Now, we do see the RDSP and the disability tax credit working together. So taking full advantage of those tax credits and deductions, There's an example here from 2016 to 2019. You'll see those federal deduction amounts increase as per inflation. Now they're about 88, as Daniel had mentioned. And there's provincial deduction amounts. When everything shakes out, this could mean that someone is paying $1,600 less in taxes, okay? Now, how does that work with an RDSP? Well, if we redirect $1,500 of that return into the RDSP in a low-income family, that could mean that the contribution was $1,500, the grant's $3,500, $1,000 in bonds, and we've used about 6% growth, okay? Now, total contributions after 4 years, out of pocket, it was zero. Remember, it came from those tax returns because of the deductions. Total contributions from the refund was just $6,000 over the 4 years. And the potential account value is $27,000 or $28,000. So you can see how significant this can be in someone's life. And after just 4 short years, it could be almost between 25, 30,000. We could see in 20 or 30 years, this could be a big portion of someone's retirement plan. Now, there are 2 types of payments. This can get very convoluted, so I'll try to give you the most important points here. A disability assistance payment is a discretionary payment. It can be made pretty much any time, okay? There are some rules depending on whether the RDSP is a PGAP or a non-PGAP. That's a primarily government-assisted plan, okay? If there's more money in the RDSP from the government than from the beneficiary, that means it's a PGAP. So there could be a limit, or there will be a limit on how much money you can take out as a disability assistance payment. If it's not a PGAP, there's no maximum until you reach that, okay? Until the government contributions and your contributions are now equal, then it would become a PGAP. There's also lifetime disability assistance payments. Those automatically start when the beneficiary turns age 60. Now you'll see that the government was clever here. Automatic payments start at 60, and government grants and bonds, you're no longer eligible for them when you're 50. They've given themselves that 10-year timeline, so that when the LDAP payments start, there's no clawbacks, okay? At least 10 years have passed. Now there is a formula for the lifetime disability assistance payments. I'm happy to get into that if someone has that question. It has to do with the account value and the beneficiary's age at the time of withdrawal, and they create an ongoing payment amount. So a few more details on primarily government-assisted plans. An RDSP is considered this in a year when the total of all government grants and bonds is more than the total of all private contributions. So again, when the RDSP is a PGAP, the total of all payments out must not exceed the greater of that formula or 10% of the whole account value. Now, the assistance holdback amount happens regardless of whether you have a PGAP or a non-PGAP. And the assistance holdback amount is equal to the total of all government grants and bonds paid into the plan in that previous 10 years. So if the AHA is greater than 0 at the time you withdraw, meaning there are government grants and bonds within those 10 years, if you take out $1, you will have to repay $3 of the AHA back to the government. So you can see that an early withdrawal, for example, of $2,000, if there's money in the AHA amount, you could be paying $6,000 back to the government for a $2,000 withdrawal to you. Okay, so we do want to be strategic and when we're collecting those and when we need the money out of the plan as to avoid those clawbacks. Okay, so what could go wrong? I'm all about good news and positivity, so I'm going to leave it to Daniel to tell you the few things that could go wrong.
I'm the doom and gloom guy who does the things that go wrong in the estate planning stuff and tax. Oh, goodness. No one should be envious of my portion of this presentation. Anyway, we do want to address a few things that can happen that you should be aware of. One thing I can't stress enough, and I think what Maria just illustrated, is that using an RDSP, using the disability tax credit, using these things to advance your financial position is not something that should be done by somebody who's not well experienced in this area. Now, I will say I have met a lot of survivors of motor vehicle accidents who are quite capable and have done a lot of research, and other people with disabilities, either acquired a brain injury or have slowly progressed over time into issues that are associated with their brain injuries or other injuries, who are very capable at managing this. And the goal today is sort of to empower you with that knowledge. If this is not something that you feel like you should be doing yourself, I don't want you to think that you can walk into your local branch and have them be well-versed in this, because they're not. And Maria will speak with firsthand experience with the number of times that we have had to clean up mistakes made by other financial professionals in this area. So let's take a very quick look at them, and then we'll get into some of the questions. So one of the things is you don't have enough time left in your time horizon before age 49 to collect all of the eligible grants. This is a common one we see, particularly in the motor vehicle space, because people tend to want to wait till their file settles before they think, oh, I need to open an RDSP. The problem is, if you were injured at 45 or 44 and litigation drags on till you're 47, 48, 49, then there's not enough time for us to reach back. Whereas somebody in their 30s who's injured, maybe 32, settles at 37, we can reach back and collect those grants, because as Maria's example said previously, that you can go back and collect some grants from past years, and we can go back to the date of loss or the date of disability, as CRA will call it, and work forward from there, but no more than the current year and the 2 previous years. So that's a key consideration. Don't let this linger. Also, of course, we can reach back for grants and bonds. We cannot reach back for growth. So that growth will be lost forever if this is left to linger. The only time that this sort of has a little bit of a calculation as to whether or not you should get going on an RDSP right away is in the case of a minor. So if someone's under the age of 18, how the household income is calculated, things like that, that requires a little bit more analysis. But for the most part, anyone who's a capable adult who is DTC approved, you should get going on the RDSP ASAP. Sorry, that's a lot of SP acronyms. Anyway, there's also not enough time to park the assets. As Maria mentioned, some people want to start contributing to collect all of those grants, and then as soon as they've caught up all the grants, they want to start drawing that money back out. But as Maria explained, in a PGAP plan, if you play that game with CRA, they start taking back what they gave. Now, that's not to say that that's a complete loss, because they don't claw back the growth. So it can act as a bit of an investment loan, and you would have to repay the loan but keep the growth. But don't think of it as something that you're going to be able to snatch up all of those grants and bonds and then immediately start drawing. The best thing you can do is, of course, park it for 10 years so that all of that government assistance vests and is yours to keep. Not enough contribution room. We've seen this time and time again done by a bank advisor or somebody unskilled in this area, particularly in the realm of motor vehicles, where there's a significant settlement from the insurance company and they go and max out the account by putting a full $200,000 in there. Well, if you do that in one shot, you will not trigger the grants in future years. And you also may forego any RRSP or RESP rollover room that you may have otherwise been able to take advantage of. So the RRSP rollover could be a spouse or a parent upon their death. If there's money in their RRSP that is coming down as an intergenerational wealth transfer by the estate, that can be rolled into an RDSP, thus reducing the amount of tax that the estate pays, either an income tax or estate administration tax or both. And also the same thing can happen with an RESP. If there isn't enough contribution room in there and the person who was injured did have an RESP and that money then can't be rolled out, then it comes out, the RESP is collapsed and all of the grant money goes back plus an additional 20%, because in an RESP, the government does claw back grants by way of tax. So, or sorry, growth, they do claw that back. So those can be lost advantages if the account is set up by someone who doesn't know all of these details, which basically brings me to the final point, which is unfamiliar territory. And I can cite case upon case upon case where we have had clients who went into the bank because they received the letter from the government saying you're RDSP eligible, and they went in and something happened that was just set up wrong, done wrong, or what have you, and we have a very difficult time getting the bank to accept responsibility and collapse the account and start over. And even then, how many years later has that happened? What happens now for our ability to catch up grants? ODSP income preservation, and I've seen some questions on this and we'll get into this in a little bit. ODSP does restrict or have rules around the amount of assets and the amount of income. And it's important that you don't confuse the two. So there are exempt assets such as personal injury awards that do not have a component for future loss of income. So two sides to a personal injury case. There's the accident benefits portion and there's a tort portion in many cases, not always, but when there are two components, how that gets broken down and how that's managed is very important, because if there's a lump out for an income replacement benefit or what we call future loss of income head of damages in the tort, those things can put you offside with ODSP. However, some of that can be managed in a way that could keep the award on side from an ODSP perspective. That is a case-by-case basis kind of thing. Assets in an RDSP are considered exempt. That said, you cannot bury income in an RDSP necessarily, certainly not without an exception or special ruling from ODSP in that regard, but it can be considered exempt. So the single person limit for assets is 40,000 for couples. It's 50,000. Principal residence is exempt. One vehicle is exempt. As I mentioned, when it comes to personal injury awards, some of it's exempt. Money in a Henson trust is exempt. Henson trust, this is a whole other presentation that we may do at a later date on estate planning for parents, because this does not apply to the world of personal injury. And we do get a lot of calls on this saying, can't I just take my personal injury award and stick it in a Henson trust and keep my ODSP so that I'm not offside on the asset limitation? The answer is no, because that's gifting. A Henson trust is an absolute discretionary trust, which means it's like another person, it's a legal entity, and you cannot give your money away for the purposes of keeping ODSP. So how a Henson trust is best used is in estate planning. Mom, dad, grandma, Uncle Joe, somebody's going to leave money to the person who's receiving ODSP. That should go into an estate plan, or sorry, into a Henson trust by way of an estate plan. And that plan should be common across all other family members so that their wills all say the same thing, which is basically first to die creates the trust and subsequent deaths fund the trust further. But again, that's another presentation and there are a whole lot more rules to it than that. So ODSP, as I mentioned, has two rules. They have the asset limitation, they have an income limitation. Their income limitation says that you are allowed to make $10,000 per year from any source. And some income from an RDSP can be deemed a source of income. That gets very complicated, and it's in that same formula that Maria was talking about with PGAPs and assistance holdback amounts and how all of that shakes out and what is grant and growth and all of that all gets factored into how ODSP calculates income. So which is why typically, and again, the design of the account from the CRA perspective is largely that this would start paying out at age 60 or age 65, or it is designed to be a retirement account. The initial construct of this account was to replace the RRSP for people who have lost their ability to work and therefore lost their ability to accrue contribution room to an RRSP, and of course losing that tax advantage. So that's what this was designed to be, plus the grants and the bonds, because the CRA recognizes, or the federal government recognizes, that persons with disability have increased costs, particularly in sunset years. A lot of people in a normal, healthy life without injury, without disability, don't spend all that long in a care facility. People who do have injury, whose health will deteriorate a little bit faster, but not on a completely accelerated basis, may spend longer in a care facility simply because the nature of the injury. But this can get complicated as well. So anyway, I don't want to go too far down this rabbit hole either. The idea is that an RDSP is supposed to be used as a retirement account, and the funding that goes in there is largely deemed to be for those sunset years. There are some changes to the rules when a medical professional says that the life expectancy is going to be reduced. So income from a structured settlement is exempt as far as ODSP is concerned. So a structured settlement, for those who don't know, is a tax-free annuity that only people who have suffered a loss due to personal injury are able to use. So it is a very specific tool, and ODSP very recently, I think 2017, allowed structured settlements to be exempt up to the amount that was put into them. So you're purchasing an annuity when it's a structured settlement. If you buy one for 100,000, the day it pays back 100,000, you're now offside with ODSP. If you purchase one for 500,000, the day it pays back $500,000, you're offside. So that can be set up in a way that again can push that out to age 65 so that you can preserve ODSP throughout. But again, a little bit more outside of the scope of today's presentation. So some of the tricks of the trade too could be that you can use non-exempt income to purchase medical, childcare, one vehicle. You can buy all of these, some of these things that are deemed to be exempt, and ODSP will reevaluate what your income level is because it will be net of these things. So that's a great way to take some. If you're over $10,000 a year in income, you can use some of that money for treatment, therapy, and other exempt assets to get some of that income deemed to be exempt. But this, in the world of personal injury, again, it starts to become a little more complicated because the valuation starts after the net settlement disclosure notice. So if there is an income replacement benefit in the accident benefit settlement, that's going to be examined by ODSP. Now, again, that doesn't necessarily mean they're going to cut you off. They may claw back some money for past expenditures, which usually happens when someone is deemed to be non-cat and then later deemed to be catastrophically injured, and they will then adjust how that works and allow them to keep their ODSP benefits. In some cases, it's non-monetary. In some cases, they reduce the entitlement. All of that sort of comes into calculation. So we touched on estate planning and this already, so I don't want to spend too much time. But what could go wrong in this space is that if those wills are not properly worded, for the sake of in some cases, a small inheritance, you could end up losing ODSP. So we want to make sure that that is done properly for any family member that might leave money to a person who is on the ODSP program. And these can have serious ramifications, not only by loss of income, but increased costs, loss of medical, dental. These sorts of things can be very tricky. And now this is a bit of an evolving space, of course, as the new Canadian budget announced a national dental care program. Of course, that's not in force as it stands. So we may see that evolve as sort of what the financial ramifications of that would be. But suffice it to say that estate planning is an extremely important area for anybody in the world of disability. So just to go a little bit further on this one, we want to make sure that there is an amount or some space in the RDSP, as I mentioned, to allow for that rollover possibility. If that can be used, of course, that would require some analysis. This, again, reduces the estate administration and income taxes thus increasing the amount of wealth that is transferred. You want to be protecting this. The government assistance could be impacted by subsequent beneficiaries on a RIF or anything that happens in our RSP rollover. So these are all very important things that need to be examined in estate planning. ODSP, I think I've already beaten that horse enough, so we won't go too far in it. And this is why we always talk about trusts and how they are done, and life insurance and how that works, because up to certain limits, those can be exempt if they go into the right vehicle in the right way. So just to wrap this up, and then we're going to jump into the questions. This graphic, I think, explains it very importantly or very clearly. What you are contributing to your RRSP is really the tip of the iceberg. The overarching investment strategy and account strategies count for a lot. How those accounts are used, how they're set up, how the tax is managed, who's deriving the benefit from the tax credit. Is there enough contribution room or rollover room? Is there enough time? All of these things come in to factor when we are looking at investment or account strategy. And of course, as I've said already multiple times, the intergenerational estate plan, this stuff is very important, and it is an area that goes wrong very, very often. And as Maria said, all of this needs to be integrated into a greater financial plan, because there's risk to consider, there's cash flow to consider, there's, we obviously tax, but all of these things, all the different components of a financial plan need to be very much constructed on a customized basis around the rules of disability finance that not a lot of financial professionals are aware of. So with that, I want to jump into the questions. Unless Maria, you think I've missed something, I'll just jump right on into that. I'm going to stop sharing my screen. How do I do that? Oh, it's over here. Stop the share. There we go. Okay, let me call up my question sheet. Okay, so some of the questions that came in on the Q&A, we're going to address right out of the gate. Oh, there was a first one. Maria, did you answer the first one?
I did answer a few
Okay.
You'll see under the answered tab.
Oh, the answered tab, yeah.
But in the open, there's a few that we should answer live.
Yeah, I will. I just wanted to circle back because Rich, you had put one out right away, just as we started.
Yes, can you claim disability when you're about to receive a partial pension? There may be a spousal reduction on the overall amount. Is there a dollar amount that cuts you off?
Yeah, so this is important to understand that the disability tax credit is not income tested. It is strictly based on the whole person impairment or marked impairment in one area. And a marked impairment basically means that the person with the disability takes 3 times as long to perform the same task as somebody of a similar age, and that, or 3 times or more, and is this way substantially or all of the time. That was the old language. Now they say 90% of the time. So changing that language did move the threshold up. I know that the Disability Advisory Committee is working to again have that language evolve, because we do believe that it is too restrictive. And incidentally, Maria and I are pretty active in advocacy work in this area as well, because we can speak firsthand to the rate of dissipation of personal injury awards for sure, but also the increased cost that persons with disability are faced with. So if the qualification for the DTC is too restrictive, that is not tax equity for Canadians. And we work very hard in this area. But that's a quick aside, just to say that if you claim disability, so Rich, what I'm not clear about in your question is, are you talking about the disability tax credit, or are you talking about CPP disability as a benefit? Regardless, neither of them is income tested. They both are largely based on your disability status and what you contributed to CPP. along the way. So how that works in retirement and how, if there are adjustments for pension, the short answer is no. Sorry, I should say they're not asset tested. So if that's your question about CPP disability, perhaps you can shoot us an email and we can get into it further. But the answer for today's presentation is the disability tax credit would not be affected. Okay. Jill asks, can you initially claim the DTC and then later transfer it to a working spouse? Yes, you can. You can have the DTC changed at any point in time. There's an application for it that you can find on the CRA website, and it's a pretty simple process.
Now that person must be eligible to claim the disability tax credit as your caregiver. So I couldn't give it to my neighbor because my neighbor is not providing care for me. So if grandma comes over and helps me once a day, or if mom is providing support on an ongoing basis, there is that eligibility to transfer that disability tax credit over to that person.
And Maria, did you want to answer the second one or you want me to field that one?
Go ahead. I'm just trying to keep up with what's coming in.
Sure. Okay. Can Hudson Wealth and Trust Planning Group assist people in opening up an RDSP if they already qualify for the DTC? Yes. Yes, we can do that. I won't get into too much of this today. If it's just simply the account that you're looking to manage, we can talk about it. We are a financial planning firm predominantly. We do wealth management as well, and that sort of investment accounts kind of falls under that category. But yes, we can help with an RDSP. However, if you're looking for more of the meat and potatoes of what we discussed today, that's more in the category of financial planning to ensure that the account is set up properly and what goes in is properly managed and all of those sorts of things. So that's a planning engagement. But if you just want the account set up, we can also help with that.
There's another question from Shirley. If someone's 50 years old now, what would be the benefit to work on for the next few years, tax-wise? So are there any things that we can do tax-wise that could benefit her situation? One of them would be applying for the disability tax credit. Again, that could be used on any source of income, those tax deductions.
At any age.
At any age. If you are approved for a disability tax credit, you could open an RDSP. Now at age 50, you wouldn't be eligible for grants and bonds. However, it could be a place to put some funds to have tax deferred growth so that growth does not impact your current taxes. And it can also be a way to help preserve some government benefits if those are income tested or asset tested. Okay, we have another question. Danielle, I think there's a couple here. I'll send them to you. So if a minor is approved for the disability tax credit and the family starts contributing to the RDSP, however, the disability tax credit expires, what happens to the RDSP?
Yeah, it basically goes into stasis. You can't contribute to it anymore. It is not forced to collapse. They used to force you to collapse it. But the good news is now it can stay open. You have to take that 10-year timeline so that all of the grants and bonds are vested. Also, as anybody will tell you, certainly in the world of brain injury, if you lose your qualification today, you may re-qualify tomorrow. So you don't necessarily want to throw the baby out with the bathwater in the sense that you would collapse the account and give up all of those grants and bonds. But again, I think the best strategy here in the case of a minor child, if it's not renewed, leave the account sitting there. It will continue to grow. You can manage the investments within it so that you're adjusting to market trends and things like that. And then that way you're continuing to maximize the growth in the account. And if you're able to do so, be aggressive in this stance, if that's within your risk tolerance, then you can really derive some benefit of tax deferral later on in life. And if the DTC is approved again later, then you may very well go back to contributing to that account. And that does happen, and not all that infrequently.
So I believe that also answers Sherry's question about what happens if you lose the disability tax credit. Sherry, please let us know if that hasn't answered your question. We have something from Darlene. I've been approved for CPP disability. and want to apply for the disability tax credit, but not sure the right language for the doctor to use on the application. So again, Daniel had mentioned it's not what the injury or disability is. Daniel and I could have the same injury or the same disability and it affects us differently. It takes me 2 times longer to cook a meal. However, it takes Daniel 4 times longer. So in that scenario, Daniel would be more eligible for the disability tax credit. If something affects me only 50% of my day or my life or the month, and it affects Daniel 90% or more of the time. So 90% of the time he has back pain, 90% of the time it's difficult to perform this task of daily living. Those would be the differences. So again, I would suggest before you go to your doctor, make some notes and ask yourself some questions about how does this affect my day-to-day life? Does it affect when I walk? Does it affect when I'm cooking a meal? Does it affect my decision-making? So again, we don't want to focus on what the specific disability injury is, but try to reflect and maybe have a conversation with someone who knows you. Maybe have a conversation with your best friend or your mother and say, you know, could you give me some insight on how this is affecting my life? And just have an open conversation and make some notes, and that could be helpful when speaking to your doctor.
And it may, to Maria's point, may very well be worth your time to have that person also speak to the doctor. If they say that I've seen a real change in my sister's behavior, that she's forgetful all the time, that she has debilitating anxiety, that there's an impairment in executive function. These are the things that again, and I meant to say this earlier, it's very difficult to get a general practitioner, a GP or a family doctor to speak to this. We find in our experience and in our practices that family doctors tend to be far more physiologically focused and don't necessarily connect with or speak to or identify the cognitive impairments that come with ABI. And that's why we generally recommend that in this space that somebody seek, you know, neuropsych, psychiatry, psychology, somebody else who can speak to the cognitive impairment, because that's going to count for more. And the other thing is, just by the nature of their practices and the nature of their experience, GPs tend to downplay a lot of things. And I don't know, I'm not suggesting that they're jaded or anything like that. I just think that they tend to sort of look at things in a statistical representation across a greater population, where they're being their practice. Whereas I find that psychiatry and neuropsych tend to be very focused on the individual functionality of the individual patient, and that's why when we're coming at this from the perspective of brain injury, these are better medical professionals to use in the completion of the form. So that's why, you know, generally we recommend going to them.
A quick example of the verbiage differences on these applications. Someone could say, I have difficulty getting out of bed in the morning, and that's part of the injury and the disability. However, there's no quantifier there. So if that's a note that you wrote, that's great. That's great to reflect. However, take another look at that statement and try to quantify it and say, do I have trouble getting out of bed more than 90% of the time? Or does it take me 3 times longer to get out of bed and dress myself? Okay, so those are the 2 quantifiers that they are looking for. Write some notes and then go back and reflect on those notes, try to quantify things.
For sure.
Daniel, I have a question. Oh,
yeah.
Daniel, I haven't had to fill in the form, but the page 2 of the form where you have the medical practitioner complete it. Mm-hmm. Is it only one medical practitioner? Like you have to pick one, or can you have several?
Good question. You can have several. Generally speaking, you don't need more than 2. Meaning you could have an occupational therapist speak to your ability about feeding and dressing and these sorts of things, or speech language pathologists who can speak to obviously speech, and then another doctor, a GP or something else who can speak to the effects on day-to-day life. That's generally it. Now, I'm not saying there's anything wrong with throwing everything at it. If you have multiple doctors who will fill out the form for you, there's nothing wrong with having multiple doctors fill out that medical practitioner portion. The problem you've got to be just mindful of when you're sort of planning this out is that you want to make sure that none of them are going to contradict the others, because that is going to just get it sent back. It's going to be sent back for clarification. It's going to create a bigger hurdle to cross. So typically we would say that 2 medical practitioners is what you would need if one isn't able to speak to the whole person impairment, which is a bit of an insurance term, but you know, that impairment across all areas of life or functioning in life. That's generally the approach. If you can get 2 that will sort of speak to that, then you're good. 3, I would suggest, is probably the max. And again, focus on medical doctor. Someone who's been to med school counts higher. I think that's an unfair bias, but they do generally weight medical doctors with medical degrees a little bit higher than, say, a psychologist. But I do think that, you know, again, cognitive and mental treatment professionals are likely to speak more to your impairments than a GP who does. So that sort of just contradicts what I've said. But I think, again, the strategy here best deployed is which doctor or doctors or treating professionals are going to speak to your whole life impairment and how this disability or injury is restricting your quality of life 90% of the time. Okay.
And then just one more thing, Daniel, in the
Yep.
answered Q&As.
Yep.
There's one from a Monica.
Oh yeah, I see that.
I answered that privately, just saying that you're going to address it.
Okay, and you want me to address that now?
I think that's the same
Sure.
as the email that you received.
Oh yes, I am going to
Yes.
address this. Yeah.
Thank you.
Okay. Yeah, Monica, I'll speak to that in just a moment. Eric had asked, he's approved for CPP disability. Does that qualify you for the DTC? No, it does not automatically qualify you for the DTC. And this is actually a little bit frustrating for us, because particularly when we look at the motor vehicle accident space, where we have perhaps both the insurer's doctors and the plaintiff's lawyer's doctors say that this person is catastrophically impaired, which means either they have a marked impairment in one category, which coincidentally is the same thing as a disability tax credit form, or they have a whole person impairment. But I guess ultimately that the threshold for catastrophic in the insurance world is a 55% whole person impairment rating. And in the disability tax credit world, it's higher than that, which again, we're arguing in our world of advocacy that is incongruous with the medical world, and it doesn't add up. Those, you know, it's very hard for us. We keep asking CRA to square that for us, and why they think that if you're entitled to catastrophic limits under an accident benefits policy, why wouldn't you be entitled to the disability tax credit? Clearly, you're catastrophically and whole person impaired. So that's kind of frustrating, but no, none of these other things. If you qualify for ODSP, you do not automatically qualify for the DTC. If you qualify for CPPD, you do not automatically qualify for the DTC. So it's still an application process, and all of the things that we've talked about with regards to the medical professional, that language has to be there. And it's an unfortunate reality in this space. Okay, Ed says, if the MVA occurred at age 48 and now 57, no available grants or bonds. That's correct. But can still benefit from the RDSP. Yes, you can. 150K room for RRSP contribution based on previous income. Our RSP contribution room is not related, does not automatically transfer over to an RDSP. RDSP limits are still $200,000 lifetime. Does it make sense to open an RDSP and put current disability income to RDSP for the next 10 years to allow for growth, avoid penalty on early withdrawal to offset? So I mean, very quickly here. Yeah, Ed, your situation is this. You can reduce your tax exposure by using the RDSP. At age 57, you've only got 2 more years left to contribute to it. And there isn't any worry about a 10-year timeline or vesting for you in that case. You're going to have to start withdrawing from it at age 60 anyway. But it's a good place to, if you have the income now that you need to shelter to derive tax benefit for the next 2 years, it's a good place to do it. Okay, Monica.
I just want to add quickly to Ed's scenario that once you do put funds into an RDSP, once you turn age 60, you must start taking an income. Whereas if you put that money into an RRSP, you don't have to start taking that income till between age 65 and 71. So it really depends on what your income is now, and if at 60 you want to add to that income from the RDSP or not. So there's a little bit of a balancing act between each account.
Okay. And Monica, your question, I believe, is largely based on the fact that you were injured or disabled several years ago and were not able to receive CPP disability. So again, I want to make sure that you're not confusing the disability tax credit with the CPP disability. So CPP disability is, of course, income. And it is not a tax credit, and it is taxable income. So the two work together fairly well. So you can apply for CPP disability and the disability tax credit and go from there. Now, I understand that your CPPD application has been rejected because you haven't contributed to CPP in the last 5 years. So one of the criteria to qualify for CPPD is that you have made valid contributions to CPP for 4 of the last 6 years, or have contributed for at least 25 years, including 3 of the last 6 years. So those are fairly strict requirements. And if you're several years post acquiring a disability or post being deemed disabled, and you did not apply for it back when you were disabled, you still have what's called the late applicant provision. So you can apply, but you still will be subject to some rules of eligibility, which is to say that you had the requirement amount of CPP contributions at the time and the number of years from the date, within the date that you first came disabled. So if you were disabled in 2015, let's say, but you had been working and paying into CPP for the years prior to that, maybe not the full 25, but you would have been paying in there, you can apply under the late applicant provision and apply for special consideration. If you had not contributed to CPP in 3 of the last 6 years prior to injury, you probably will not be deemed eligible. Now, that's for CPP disability. There is also the Ontario Disability Support Program, which does not have the same restrictions on contributions to any tax regime or pension to qualify. So the only thing that's going to render you ineligible for ODSP will be based on assets and things like that. But again, a lot of them can be deemed exempt if that's your case. I think. So I'm seeing the words here, catastrophic impairment, which that comes from the world of insurance. So I see, yeah, you were involved in a motor vehicle accident or an accident of some sort. And that, again, to my earlier point, you're not automatically qualified for CPP disability because you were deemed catastrophically impaired under the Ontario Insurance Act. Again, you got to think that, that we're dealing with federal systems and provincial systems. They don't always agree. They don't always speak the same language, and they're not always interlaced. And certainly the world of automobile insurance is not interlaced with the Canada Pension Plan. So that's a little bit of a gap for you to cross. to go further into your case, I think would be more of a one-on-one thing. So for the sake of today's presentation, I hope I've answered your question enough. If you want to know more, you can certainly reach out. Maria, maybe we'll post our contact information in the chat. Okay, jumping back to Maria here. Does a neuropsychologist count as a medical practitioner? Yes. Should I get my MD and my neuropsychologist to complete the disability tax credit form? I think that's a great way to go. I would start with a great conversation with your neuropsychologist and speak to the neuropsychologist to see if he or she will speak to you being 90% impaired, or again, taking 3 times as long to do one of these tasks as somebody of a similar age without the disability. Because if the neuropsychologist will say that, you don't need the GP. And you risk having a GP saying, physically functional, can handle day-to-day events, not 90% impaired. So that's the tricky part here. And I'm not speaking ill of GPs. I think they're great at what they do. It's just that in our practice, we have seen more rejections, particularly in the world of ABI, when a GP is the only doctor filling it out, or in this case, might dilute what the neuropsychologist would say on the form. Maria as well. I had an MBA at 61, now 68. Found catastrophic impairment at age 62, 63. What benefits should I pursue? I would suggest 100% going after the disability tax credit. If you have any tax exposure anywhere, or anyone providing care has tax exposure, it's a valuable tool in this case. Other than that, I mean, you may still be eligible, now 68, so not eligible for ODSP anymore, or CPPD, unless you have contributed to CPP, and that you would be getting a disability top up on top of your CPP drawdown.
And we have a question in the chat. Can you make too much income to apply for the disability tax credit? I was told I don't qualify due to income.
Right. I think I crossed wires on this earlier. CPP is not asset tested. CPPD, it can be income tested, but it is sort of a case by case basis.
Now, this question, I believe, is specifically the disability tax credit. The disability tax credit application does not take into consideration any sources of income or assets. Now, in order to utilize the deductions and credits that come along with an approved disability tax credit, you do have to have some income, right? They're non-refundable. So it means if you have income, you have tax payable, it will help reduce the tax payable. Okay, so there's no income test to whether you can apply for the disability tax credit.
Right. So, and with CPPD, they generally work case by case. You know, ODSP has a bit more of the blanket rule that if you make more than $10,000 net income, you're off. CPPD can be a little bit more case by case. And, you know, they do have income limits, but again, you can demonstrate increased costs and these sorts of things. You may very well receive that exemption to be able to continue to earn the income you're earning and still collect CPPD. So it just sort of triggers you know, when you're over a certain threshold, it triggers an amount, or it triggers an evaluation. And in that evaluation, you'll be able to make your case.
Now, it also depends on the type of income. So CPP disability, and ODSP view incomes very differently. So rental income or investment income is income in ODSP's eyes, and they could claw back. Any type of income that's coming into the household, ODSP wants to know about it, and they could claw back. With
Including capital gains, Sorry, Maria.
That's okay, it's a good point. Unrealized capital gains. Now, CPPD, they're worried about earned income, okay, in most cases. So if you're earning an income, then CPP disability may be off the table. But if you have investment income or even rental income, in some cases, you may have to give an explanation for this. But in some cases, rental income may not be considered in CPPD's eyes as earned income. So CPPD may not claw back based on that. However, ODSP would claw back based on that.
Yeah, ODSP is probably the strictest as far as testing income and assets. If you live in Ontario, obviously, but I can tell you that Quebec's program is much more restrictive. No exemptions for primary residents, no exemption in Quebec for vehicle. These are all added into the asset calculation. So ODSP, while strict, is not as strict as other provincial programs, but CPPD is a lot more forgiving. And certainly, you know, you can make a case, which is a nice thing, where very rarely do you ever get to, you can appeal ODSP, but you can't necessarily get out of it. Whereas with CPP, you'll be a little bit more. So I just saw something pop up. I think it was in the chat. We should try to keep questions to the Q&A section, not the chat, because we're not monitoring the chat as much. So if you have put a question in the chat, can you please put it in to the Q&A? But Veronica, now that I'm seeing your question here, would LTD benefits impact CPPD? Usually not, right? Again, case by case basis. But in most cases, long-term disability benefits are not treated as income and therefore would not be calculated in the income test to CPPD. I don't know why that is, because technically it's income replacement, right? It is insured income. When you buy a disability insurance policy, you're insuring your income against disability. But for whatever reason, CRA is exempting it. And that I'm speaking to from a case experience, not from research. So don't quote me on that. But that's basically I've got a couple of cases where it's not factored in. So that's the situation on that. Again, in these cases where you have very specific questions, it's sort of that you're worried about your qualification or your income testing. Sometimes we can answer those questions. Sometimes we have an accountant that is very well versed in disability finance that we refer those questions to. So, you know, sometimes she will have better explanations as to why the rules are the way they are. She's a very good understanding of it as well. Okay, so we're still okay on time. Let's jump into some of the questions that were emailed in ahead of time. I apologize to anybody if these questions were from people who were in the last session and are not in this session, but they're good questions. So I think they're good for the purposes of discussion. We have covered off some of them, so I'll try to skip through them. One of the questions came up last time. It was a great one. I'm glad that this came up. That says, beyond the DTC and the RDSP, are there investment vehicles and opportunities for individuals with an ABI to pursue entrepreneurial endeavors? I'm going to paraphrase or add that in at the end. Yes, there are supports for people who are looking for entrepreneurial. Coincidentally enough, just came up this week, ODSP will give self-employed people a $500 one-time stipend to help get a business up and running. That, of course, is in ODSP's best interest, because if you're going to start a business and become self-employed, they want to help, because once you're employed and making money, then you will go off of ODSP. So they do have that. The other thing that's out there that we've seen in our practice that is an excellent program, it is, I believe, funded by the province, but run by the University of Toronto. It's called Rise Helps. Rise Helps is essentially a program that helps would-be entrepreneurs or small business owners manage or create a business plan. And the idea is that they want to walk you through the process of creating a business plan to help ensure or help give your business the best chance it has to get off the ground and get going. In addition to that, they provide a low interest business loan. So they will help you plan how to bring your product or service to market. They will also help fund the startup. which is good because startup loans are not usually inexpensive and very hard to come by. So this is specifically for people with disability, and it is a great program. And the loan is very reasonable, but the one thing you want to be mindful of is they are looking for shovel-ready projects. And that means that you have a developed product or service. You're not in the concept stage. You've got something, an idea, a product, a service, something that's ready to go, and you truly believe that it will be successful in the marketplace, and you are therefore at the business planning stage. So that's something to keep in mind. It's not something you kind of jump in to see if maybe you'd like to start a business someday. You got to have a business in mind that's ready to go. Does your disability tax credit have to be redone or updated every 5 years? As we mentioned, it's either 1, 5, 10, or indefinite, and then you would have to renew on those. Somebody asked how the disability application could be made cheaper for survivors when some of the professionals are charging a fee for the paperwork. That is unfortunate. It is an unfortunate side effect. Some doctors, because doctors bill by the hour, they want to be paid for putting the time in to complete the application. The bad news is there's not much you can do to circumvent that, and you are going to want to use the best doctor you've got in your sphere of treatment to fill it out. The good news is that expense will be deductible under the tax credit. So if somebody in your family is going to be taking the tax credit because you have no tax exposure, perhaps they would pay the $200 because they will get it back, or whatever the fee for completing the application would be. How far back can you go to collect the disability if an injury took place in 2015? You can reach back 2 years at a time to a maximum of 10. So that's the current year plus 2 years back until you're all caught up. So for the person who was injured in 2015, they would be able to collect all of those grants by contributing $1,500 for each year. So $1,500 for this year, $1,500 for last year, $1,500 for 2020, and then that's going to bring you caught up for this year. Next year you will do for 2023 and 2019 and 2018, and then and so on and so forth until you've collected all of those backdated years. I have a newly opened RDSP account. How do I make sure I've maxed on the available contribution room? Can I call CRA or email? Yes, you can. I believe in your My CRA account too, it will show contribution room for any account that you're eligible for. The caveat here, and I hope that today's presentation for whoever asked this question now gets a sense that it isn't always about maxing out that account. You want to make sure that you're using all of the advantages of an RDSP, not just maxing it out and getting the tax deferral on it. You want to make sure that you're triggering grants, collecting bonds if you're eligible, and leaving contribution room for any rollovers if that's a factor. If it's not a factor, and you know, for somebody who's 55 years old and has $200,000 sitting in a non-registered account, and they're not going to need it, and they're ready to put it away, yes, go ahead, stick it in there, max out the account and defer it. If you're not going to be receiving any inheritances or rolling over anything else into that account, go ahead. But that's about the only scenario where you would just plunk in the max value, certainly in one shot. You want to sort of build that account over time, and again, have those 10 years to vest, and if possible, leave room if you're going to be receiving an inheritance.
Daniel, we have a live question.
Yeah.
Someone who supports you through financial advice and helping with day-to-day decisions, however, you do not live with them and you're not financially dependent, can they claim the disability tax credit on your behalf? So the short answer, the general answer would be no. They do need to provide, they need to be a caregiver in some way. There may be an explanation that you and the accountant can reasonably come up with and justify. However, it is providing care.
Yeah, I'll give you a really easy example. If you live in the same city and that person drops off a bag of groceries once in a while, you qualify. If you live in different provinces or different countries or miles away, don't take the risk. You're going to have a very hard time making a case that you're dependent on that person for care. Now, I sort of think that the loophole here is that, we can be having a Zoom conversation. It's very important to my mental health. You are providing care by providing comfort, and then, like, at least I can talk to you on a regular basis. There's that, but it's very difficult to demonstrate that that person is incurring additional costs. Again, the idea, the concept, the reason this thing exists is to provide some equity for people who have increased costs, and that this allows them to write off those increased costs. So that's the function of it. Are there backdoors? Are there loopholes? In most tax law there is. They eventually get closed. I'm not suggesting you take your chances, but I think Maria hit the nail on the head. Ultimately, if they're not providing direct care to you, it's going to be very difficult for you to make that case. Okay, we've got a few more live questions here. 39 was involved in the accident, now 44. Oh, yeah. So
I did type out our emails, our phone number,
okay,
our general email, as well as our website in the chat. And perhaps when we send out the mini deck of slides, our information will be on there as well.
Yeah, and you can go to our website and sign up for the newsletter. I'm not sure if that's still functioning at the moment because we had to take it down to do some retweaking on it. But do check back if it's not up there right now. I'll check with our IT guy, because you can sign up for our newsletter. We do sort of pump out little tips and tricks through the newsletter. You can also follow us on Twitter and on LinkedIn. Every once in a while, we pop those up. For Hudson Wealth, you can find us there, and there will be links to different articles and things that are of relevance to you from time to time. Certainly, as the government starts to drop new legislation, these are the things like the disability. There's a minimum disability income threshold that has been talked about. It was in the 2020 speech from the throne. We're a little bit perturbed that it wasn't in the 2022 budget. We are still pushing that come out. The Disability Advisory Committee is also really pushing for that. They're doing less work right now on DTC eligibility because they're focused on this minimum income for persons with disability. I think there's far greater value for people with disability there, so it stands to reason. But you can keep up with what's coming, because we'll be continuing to post that stuff and tweet it out. Or I don't tweet, but somebody will put that out. We'll get that out. I'm terrible at this stuff. So, okay. Can someone who supports you through financial advice, helping with day-to-day decisions, but you don't live with and are not financially dependent on? Is that the one you yeah. Okay. Sorry. I was approved for the DTC for 10 years. Then I got a letter 8 years later and was told they took away my eligibility. Why would they do that? I am still disabled. My doctor moved and my new doctor tried to fill it out and was rejected. They tightened up the year. So this is, again, falls under the advocacy work that we do. They tightened up the criteria for the DTC, and some people did get caught on the wrong side of that threshold change. And that largely came about due to the changing in the wording from the disability, or substantially all of the time, or all of the time, to 90% of the time. It also had to do with so the Harper government had the Disability Advisory Committee disbanded, and then fortunately the Trudeau government had it reinstated. And the Disability Advisory Committee puts a lot of pressure on CRA. So I don't know, 10 years, you get the letter 8 years later. I don't know where we are in the timeline today and when vis-a-vis where all of that happened with the changes and everything. It may be worth reapplying, because under the Harper government, it was tightened up. Under the Trudeau government, it's loosened up a bit. It hasn't gone back to where it was under the Martin and Chrétien governments, but it's better than it was in 2015. So wherever you are on that timeline, that may very well help you. But the language is still, in our opinion, far too restrictive. And we're working to change that. It's just that the focus right now is largely on that minimum income for Canadians with disability.
And a little bit of preparation goes a long way. I had mentioned this, that reflecting and writing some notes and quantifying things before you go in to speak with your doctor could help trigger your doctor's understanding of not just your impairment, but how that affects your life. Okay, they may see, yes, spinal cord or ABI or inflammation. They may see those things, but they may not be as in tuned, of course, as you to understand how that's affecting your life. So jot down some notes, quantify them, and then have that discussion with your doctor before filling out that application.
Absolutely. And again, can't stress enough, make sure you're doing your best to work with the right doctor to get this filled out. If you already tried with the new doctor, if that's a new GP and you can get to neuropsych, go that route, or psychiatry, go that route. You know, your chances are going to be better. Or as we mentioned earlier, using the two-pronged approach of getting two different doctors, it may help. And certainly the fact that you qualified before, hopefully will play in your favor.
Daniel, to follow up, what is life-sustaining therapy?
That's life support, dialysis, chemotherapy, you know, anything that without it you probably wouldn't last long. Those life-sustaining therapy is pretty much, that's your automatic. In the world of ABI, there aren't a lot of that automatic. Again, it's the cumulative effect that we see more and more. It's that, you know, it's memory, executive function, anger management, anxiety, cognitive impairment, chronic pain. These sorts of things add up to that. It takes 3 times longer for me to get out of bed, get dressed, and get out the door. And it isn't that I can't remember to get out of bed and get out of the door, but cognitively, I forget my keys, I forget my phone, I get the anxiety before I go out the door. That takes me a minute to sort of compose myself. When I get out the door, my neighbor's there. I might blow up at my neighbor because of anger management issues. These are the things that tend to be more common amongst survivors of ABI than the obvious spinal cord injury and I'm in a wheelchair. Well, clearly, you know, walking, dressing, feeding, when you're quadriplegic, you don't need to argue about that. We don't need to paint that picture. But in ABI, we need to be a little bit more focused on whole person impairment and the overall picture of day-to-day functionality. And I know I'm preaching to the choir on this, and I know you know that. It's just a matter of getting the doctor to say that, or the right doctor or collection of doctors or medical professionals who will speak to that. And this is where why I don't poo-poo using an occupational therapist, because the occupational therapists are going to have an understanding that it takes you longer because of A, B, C, D, and E. Now, be careful. The occupational therapist is not going to get into cognitive function diagnosis and stuff like that. You want the occupational therapist to say that my client takes longer to get dressed due to the nature of the disability, right? And don't get too far into what it is, because if the occupational therapist comes off trying to present like they're a neuropsychologist, the CRA is not going to accept their opinion. You know, they have to speak from the position of an occupational therapist. And I think that can be powerful, particularly in the world of ABI, but you'll want to back that up with GP at last resort, neuropsych or psychiatry as well. And that's crucial.
If you're looking for more information on life-sustaining therapy, on page 15 of the application, it does go through what would qualify. So the therapy supports a vital function. The therapy is needed at least 3 times per week. It's needed on average at least 14 hours per week, including the time the patient must dedicate to therapy. There's a bit more information on there on the application itself to get a better understanding.
Yeah, and the pages that support the application on the CRA website have gotten a lot better in the last few years. So there's much better instruction on there that's worth reading, or again having someone who supports you read it to you, or use a text reader on your computer or mobile device. Jane asks, when you are deemed disabled through the disability tax credit system, is it all or none? Are there given percentages of credit based on how disabled you are? No, it's all or none. You're approved, you're approved. All of the credits then apply. All of the benefits then apply. Your eligibility for RDSP, that all applies. The only thing that can become conditional is the timeline. Okay, on the list. We answered that one.
If anyone has a question and they're not able or willing to type it out, or they cannot type it out in a timely manner, just please, perhaps we can unmute or get you to ask live if that's available on the platform.
Yeah,
So
we have the raise hand feature. I think you can do that if you want to ask in vivo. Okay, yeah. So this one comes up as well, further along the lines of what you were talking about earlier, Maria, is the if a senior living in a long-term care facility, can that person transfer the tax credit to the power of attorney or to the attorney, to the POA? Again, there must be a direct cost relationship here. So POAs can be authorized to act on your behalf. It doesn't necessarily mean that they are incurring costs for your care or to support you. So that's something you want to be mindful of. We have a good question here from a social worker. I am a social worker and I'm interested in any changes and updates in recent years that I can share with the folks that I work with. A few changes have come in the last few years. We touched on them a little bit. Some good, some not so good. The not so good was the disambiguation that we talked about of substantially all the time and rephrased as 90% of the time. This actually was one of the reasons why we saw GPs tend to tighten up, because again, particularly in the world ABI, TBI, they want to speak to 90% physical impairment, and that's not, in a lot of cases of ABI, it's not a physical impairment, but you're still 90% impaired. So that's something to be mindful of. That's why we recommend, not going to the GP as a first source. The good news is that, as I mentioned, that the Disability Advisory Committee has had CRA loosen some of those restrictions back up. That said, again, they're right now they're focusing on that Canada Disability Benefit. So we'll see where that goes. We're not sure if that will be an adjunct to the CPP disability. I'm kind of hoping that, we talked about you're not automatically qualified for one program just because you qualify under one set of rules. We're hoping that this Canada Disability Benefit will be tied to CPPD and as a measure of income, but not necessarily as a measure of eligibility. Because as I mentioned, for somebody, and I think, was it Monica, somebody asked earlier about an accident back in the past and why they weren't eligible for CPPD today. That's the kind of scenario we don't want to see fall through the cracks. So we're hoping that that the Canada Disability Benefit will come through fairly soon, and that people like Monica will not get missed on this. Another practitioner is asking if there are educational Zooms for medical practitioners for completing the forms. I hope this Zoom or webinar has been helpful for anybody who's on who is a practitioner in the world of ABI. We're happy to do another presentation for medical, to strictly targeting medical professionals on what the language should look like and how to address some of these problems, obviously from the financial and tax perspective, not from the medical perspective, but we would be able to sort of have a roundtable discussion on that. If anybody's interested in that from the medical field, do reach out. Okay. Somebody asked if they're receiving CPP and OAS, are they eligible for the disability tax credit? Yes, those are both taxable benefits. So you would want to apply for the DTC. LTD, we answered that one. I think we've covered tax deferral when you're between age 49 and 59. The best benefit of the RDSP is tax deferral. Obviously not grants and bonds. I think we've covered that. Somebody asked if they can still care for themselves and their family's needs, but are unable to work outside the home due to symptoms. Should I apply? If you do not have that significant threshold of day-to-day activity struggle other than work, because it isn't about work as much as it is about your ability to feed, dress, clothe, see, speak, those sorts of things. That's the area. If you can't sort of connect the reasons why you can't work to those things, you're going to have a hard time getting approved. And you certainly shouldn't come at this application from the perspective of I can't work. It just doesn't quite line up with what the mission is here. Yeah, this one, my physician has been more concerned about blind, can't walk, etc. How do I educate about qualifying with a brain injury? I think we've sort of poked at this a few times in this presentation. GPs are just, that's the way they think. They're kind of hardwired that way. And not all GPs. I mean, I've had some very good luck with a few GPs. There's the one or two in Hamilton that were great at filling out the application. They really spoke to the effects of the acquired brain injury, even though the person could walk and get to the store and take taxis and stuff, could not drive, but had that ability. You know, they got approved based on what the GP said. So it's not that the GP is wrong. It's just that, again, they tend to be connected to the world of physical, right? And that's the thing about physician, right? General practitioner, physician. It's more physical and not neuro, not psychological.
So at that point, again, that prep work, you and a care provider could help make the case and advocate for yourself to your doctor to help them understand what limitations you have. They may not see them, or they may not be written on a chart. So that's when it comes, you know, reflect, ask yourself some questions, make some notes, and talk about each item with your doctor to help them understand and help them advocate in their own words for you.
Somebody asked what the disability tax credit renewal, it looks like it's simply reapplying. It's the same as the initial application process, just sort of, again, are your injuries still restricting your life 90%, et cetera? Yes, the answer is yes, I'm still restricted and I will continue to be for the foreseeable future. That's what the doctor has to say. And then the second question here is, does passive income, for example, investment income, affect the DTC, and can it be claimed by the caregiver? Depends what you mean by affect. It does not affect your eligibility. It is taxable income, and all taxable income can be reduced by way of using the disability tax credit.
We have a question in the Q&A. You
Yep.
mentioned you can fill out the disability tax credit application online. How does the doctor fill out their portion?
Good question. I actually haven't seen it work. I just know it's there. You would need to get, I'm sure, an email address for the doctor that would trigger a secure login to go and complete the form online. Good question. Actually, we should try that, Maria. I'll pretend to be the doctor. You send it to me. Yeah, I haven't seen it. I know it exists, and I just assume, because CRA is very good at secure login. So would be something, would have to, two-step verification kind of stuff.
So again, a conversation with your doctor before you go in online and initiate things. Again, you want to prep them, and you want to make sure the doctor understands your limitations before they go in and just start typing out some answers. Okay, so a little bit of prep work.
Yeah, and when you're talking to your doctor about whether or not they're going to complete the form for you, ask them if they're more comfortable with paper or if they're okay with doing it digitally. And I do believe you can scan and submit too now. I think you can have the doctor fill it out on paper and then scan it and upload it to your MyCRA account. What tips will you have for a healthcare provider completing the form for someone with post-concussion syndrome? Post-concussion syndrome, or PCS, is a very tricky one. The problem with PCS is that it's generally believed that you're going to get better. I know, and I can cite a number of clients who have had PCS for years and years. It's just a hard one to say that you're whole person impaired and it's substantially all of the time, or 90% impairment, or 3 times longer than someone of the same injury without disability. These ones are it's very hard to sort of make that stick in post-concussive syndrome. That said, I'm not saying you're out of the system or you're out of hope. You can still apply. Again, if the doctor will speak to the language that is required, there's no reason not to try. Have a conversation with the doctor first before you spend a lot of time on it.
Now, this is from the disability tax credit application. You can submit your form online. You will get immediate confirmation that it's been received. In order to submit online, scan your form and send it through the Submit Documents service in My Account.
There you go.
You'll have to have a My Account with CRA. In order to create one, you need to log in, create your password, your security questions, and then they will mail you a letter with your PIN. And then you go back in and you enter your PIN, and now you have an account. So that, relying on that letter from CRA with your PIN could take 4 to 6 weeks. So again, it could be a lengthy process to get that done online. Just be aware of it.
This question asks, which financial institution is the most accessible and aware of disability needs to open an RDSP, as many do not care? Yep, you're right. Many do not care. I'll go one further for you. Many advisors or investment people are afraid of these accounts because the rules are very complicated, and they're not being dismissive to you. They're sort of, I think perhaps wisely so, recognizing that they don't know and they don't have the skills and they don't have the knowledge to be effective. So they're afraid to practice in this area. So that's going to happen if you walk into a bank branch and say, can I speak to an advisor about an RDSP? That could happen. That said, you might get lucky. Obviously, from my perspective, I'm going to say Hudson Wealth has the most expertise and compassion towards people with disabilities who need an understanding of treatment and care, and how they should be treated by a financial professional. That's obviously us. Honking my own horn there. I know I'm shameless. But I will say that we've had good experience with Mackenzie Investments. If you want to go direct to the company, that's a possibility. The truth of the matter is, it's very difficult to deal with large financial institutions unless you are deemed to be high net worth. They obviously pay more attention to people with more money, or are going to buy more products, or, have big credit cards and lines of credits and all of these sorts of things. Those people tend to get more attention from large financial institutions. And this is why we set up our practice to be a small practice to focus on clients with specific needs. But you know what? There are other financial advisors out there. We've seen them. Some of them come to us for specific advice or to do specific work on specific files. We do that for other practitioners. And I'll tell you, when I started out in this business, I was very fortunate to have another advisor in my office who was the father of a girl with Down syndrome, and he had done a lot of the research, because the amount of research to practice in disability finance is massive. So it's very important, I think, to find somebody who has done the research. And if you're going to interview financial advisors or financial planners, you should ask them directly, how many other clients with disability have you worked with? Because that will speak to their knowledge. Okay, yeah, I think the last few questions in here we've already answered. So unless there are other questions in the Q&A panel, I think we've probably covered just about everything and just about on time. Look at that.
I've been keeping an eye. I don't see anything new coming into the Q&A panel.
Great.
Okay, well, I hope everyone got a little nugget from this presentation and was able to sort of take something that they can implement in their own life or to care for somebody else if they are a caregiver, and to start them on this journey. Thanks, everybody. Appreciate you attending today. I hope it was informative and not too droning. I know tax is a tough area to stay awake during, but hopefully we've provided some benefit. And by all means, if there are other questions or somebody's looking to have a conversation more privately, do reach out. We'll be happy to help.
Daniel and Maria, I just want to thank you again for your presentation. You look in the chat, there's all kinds of people thanking you for assisting them. And again, I want to thank you for doing the 2 presentations, and perhaps in the fall we can look at another one for service providers.
That'd be great.
Yep, we'd be happy to. Thank you.
Thank you, and thank you everyone for attending.
Thanks, everybody.
Have a great afternoon.